fixed and variable, I give an analogy. It's not exactly the accurate analogy, but it kind of works in a way that, see, fixed is like a rock, it doesn't move, and variable is like a water bucket, for example. So fixed is when you fix it, it's gone, it's set, and it doesn't change as per the RBA movement or the market movement for the tenure, obviously, for the period you fix your rate. Let's say if you fixed it for 3 years, it's not going to change as per the market movement. On the other hand, variable, obviously, as the name sort of says, it's variable, it changes with the market movement. And you can make extra repayments into it, you can redraw from it. So even if you don't have an extra offset facility, you can still use the variable as, as a flexible component of your loan. So the main difference is that in the fixed you can't make too many extra repayments and it doesn't change. The variable is it changes with the market and you can make extra repayments, you can redraw from it. These are the two major differences in fixed and variable. Well, that's a standard question I get asked by most of my clients. Simple rule, if you have a variable product, you try to make extra repayments into it as much as you can. Even if people usually say, okay, do I have to have an offset facility? Look, there's a bit of I'm not going to go into detail about it, but if let's say you have an investment property or even owner occupied, but you don't want to kind of get an extra offset or something, you can still make extra repayments into it. But I have to put a disclaimer here because there are all sorts of repercussions, there are all sorts of pros and cons of doing that. You have to talk to your accountant about it, how to structure the loan properly. But I personally think that you can actually make extra repayments into the variable, try to bring your principal down and try to pay off your loans faster like that. The lender mainly wants to see, they say there are 5 C's, but I would say that, to keep it very simple, just in layman's language, I would say obviously they like to see whether you can borrow this much money or not. So your borrowing capacity, which is a simple ratio of cash in and cash out. Then your credit rating, like have you had any defaults on your previous debts, or if you had a mortgage, how you've been maintaining your mortgage, what about your credit card limits. Quite a number of factors actually come into the picture, and in a nutshell, there are 2 things which I usually say that there are 2 pillars of borrowing, which is your borrowing capacity, and the other one is your funds to complete, meaning how much deposit do you have, and these days we can do up to 95% loans also from the bank. So there are a couple of factors, but these are the major 2 pillars of a loan. Okay, products, I would say that when you see the ads, you think like obviously you're bombarded with the products. There's so many different products, but fundamentally there are only 4 or 5 different products. You'll be surprised actually. It's actually on our website. If you have a look at www.allourloans.com.au, we have notified we have actually mentioned the types of the products in the industry. So apart from fixed and variable, in the variable there are actually 4 or 5 different components. You have your introductory products, you have your basic variables, you have your professional packages, and you have your line of credit. And the details of the products are given on the website, so please have a look, and you'll realize that the differences in these.